From ballast to boom and everything in between, you are listening to the Saigal Seatrade podcast. I'm Research Analyst Trisha Mohite, and today we are diving deep into tankers, tonnage, and the tides shaping the world's most critical shipping lanes. So, whether you're trading AG Japan naphtha or tracking VLCCs out of Ras Tanura or recalibrating strategy on West Africa stems, this episode's definitely for you. And joining me today, as always, we have shipping expert Mr. Sandesh Ghandat. So, welcome back to this episode.
Thanks, Trisha. I'm thrilled to be back and let's get into it.
Sure, Sandesh. So, let's start with the big ships, which are none other than our VLCCs. So, Sandesh, the Middle East Gulf's market has been shifting tone lately. So, could you tell us what's really driving the sentiment there?
Yeah, Trisha, the VLCC segment out of the MEG, that is Middle East Gulf, it has been a story of two halves. Early last week, we saw kind of a owner sentiments hold firm, largely because of a tighter supply of modern tonnage and a pretty steady stream of August loading inquiries. Now, whenever you have a constrained position list paired with some kind of forward steams that are just beginning to show the shape, and it creates that sweet spot for the owners. So rates, they kind of tend to lift slightly and then sentiments follow and then everyone leans bullish. But last midweek onwards, things kind of started to stall. And you may ask why? Because the prompt availability started to creep back in. We have early August positions resurfaced, and the big elephant in the room was the absence of Saudi Aramco's official program. That program release typically anchors the MEG VLCC market, and without it, you are basically steering without a compass. We have a benchmark TD2 and TD3C indexes. Those saw a weekly jump of 7.28% and 6.95%. Respectively, and they were closing at world scale 54.06 and world scale 53.1 respectively. So these weren't just technical moves, there were sentiments driven, and that's important. Meanwhile, we have seen another benchmark TD22, it also rose by 4.1%. And it got concluded around 7.54 million, reflecting the eastward flow from the US Gulf gaining traction. But even with that, fixture activity, they kind of remain thin. And let's not forget the WAF side. Initial firmness gave way to softer footing because the market, it opened strong with the support from the firming America's sentiment, but inquiry didn't match expectation. So as a result, we ended the week on a more cautious note. So westbound flows from the US Gulf, it's a question and it's still sluggish. In the eastbound, we saw some cautious optimism, but really everyone is waiting for those August programs to fully unroll.
Interesting insight, Sandesh. Now let's zoom in on our Suezmaxes. So I hear there's been talk on fragility in the fundamentals. So could you tell us what are we exactly seeing out of West Africa and the Med?
Well, that's right, and fragile is the right word here, Trisha. The Suezmax market, it has been struggling under the weight of excess supply, and the trend has been for the weeks now. We started seeing some early signs of a rebound, specifically out of the West Africa, where the tonnage list were slightly more balanced, and in addition to it, a few August stems they kind of popped up. So that helped boost the benchmark TD6 and TD20 routes because they both rose by 6.73% and 9.59% week on week to world scale 96.47 and world scale 88.89 respectively. But you know what? Here is the kicker. While those numbers look good on the surface, the underlying activity hasn't kept up. Eastbound voyages, they kind of remained largely inactive, and the Mediterranean interest is patchy. We have seen the Indian PSUs quoted 5 cargoes, and that's a massive for a weekly quotations from the Indian PSU. So these 5 cargoes last week, and you know what, the last one ex-MEG West Coast India, it got covered around world scale 100. So it's not bad. But it's not enough volume to shift the bigger picture. Now owners, they are kind of clinging to the cautious optimism. But until we see a stronger pull from the Med, Black Sea and maybe even the US Gulf re-exports, I don't expect a breakout. Plus the shadow of Aframaxes and LR2 cannibalizing Suezmax routes keep the pressure on.
And Sandesh, what about the Aframaxes? I mean, the pressure seems quite relentless, so is there any light at all at the end of the tunnel?
Well, Trisha, unfortunately, the Aframax segment is kind of a bearing the brunt of the overcapacity right now, especially in the Middle East and the Southeast Asia. So let's take the MEG first, that is Middle East Gulf. We have seen the benchmark TD8 index, it dropped around 5% to world scale 134.64. And the main problem is an oversupply of older tonnage parked in the Fujairah. Many of these ships are chasing the same limited pool of cargoes. So charterers, they know this, so they are kind of bidding their time. And then in the SCA, that is Southeast Asia, it's not a faring any better, because there also we have seen the benchmark TD14 route. It failed by 3.13% to world scale 112.25. And we saw a brief tightening in the third decade window, just a flicker of firmness, but that's already fading as we head into the early August dates. With three Indian PSU cargoes quoted last week, and the last one, it got fixed around world scale 170 for the 65,000 XMEG West Coast India. It's clear that there is selective demand for the quality units, but the market's kind of a structurally bearish. So we are talking about a scenario where even a minor upticks in the cargo count aren't enough to absorb the sheer volume of ballasters.
Okay, Sandesh, now let's talk a little bit about the clean tankers. Because some might say this is where the action is. So, could you tell us, Sandesh, what's giving the CPP tankers such a strong tailwind right now?
Absolutely, Trisha. The clean product tankers, they kind of have stolen the spotlight lately. So it's a cocktail of strong fundamentals and then the geopolitical catalyst. So let's start with the LR2 TC1, that is 75 KT from AG to Japan. Jumped around world scale 13.54 week on week to world scale 125.5. And you know what? That's a 15.55% gain in TC to, 25,647 per day, just over 25,000. So what's driving it? So eastbound naphtha flows out of the AG and a tighter supply of the large clean tonnage is the main reason behind it. Then you have got the LR1s, again the benchmark TC5 route. It rose to world scale 145.94. Marginally up by 2.19 points. Then we have seen the paper trades, or we can say future trading, where world scale 136.889 was achieved for the third quarter of year, and then the Q4 or the fourth quarter of the year we saw it again pushed around 693. And you may ask why I'm mentioning this, because it's classic contango structure, and you know what, that tells you the market expect stronger fundamentals later in the coming months. So TC on that route, it was around 21,188 per day. Now coming back on the EMA market, EMAs have been a red hot too, because we have seen the benchmark TC17 AG East Africa. It jumped around 10 world scale points because it got closed around world scale 226.07, and that's just over the $23,000 per day in earnings, but it was up by nearly 7% week on week. So what's interesting is how tightly balanced the MR tonnage list has become in the AG. So private fixtures are quietly soaking up availability, and we have got 35 MRs ballasting back to the east of Suez in the coming week, and within that 35 ballasters, 28 are already committed. So you have just got 7 vessels, and that's a kind of a tightening tonnage situation. And then here is the wild card, EU sanctions. So on the July 18th, that is in the mid of last week, we saw Belgium, it kind of finalized a sanctions package with the collective efforts from the other EU members. That package has blacklisted several vessels, and then the captains of these vessels, and even a flag registry. So shadow fleet operators, they are now kind of commanding premiums for Russia linked routes, and that's pushing the mainstream owners to either exit or price in massive risk premium. So rates on the Russian CPP export, they are kind of spiking, and it's a volatile setup, but short term bullish, no doubt.
Well, Sandesh, now let's shift gears to LPG, because the VLGC market, interestingly, seems to be a tale of two oceans right now. So, could you tell us what is this? What exactly is going on, and the story in East versus West?
Well, Trisha, great observation first of all. east of Suez market is still pretty flat. We have seen only 3 fixtures were reported last week and less than a third of the what we saw in the west of Suez. So rates, they kind of hovered just above $80 per metric ton by Friday, but the sentiment is tentative. So everyone is watching for Saudi Aramco's August 25 acceptances. So if they release volume in bulk, we could see a run up in the AG fixing. But then you ask west of Suez is how that is reflecting. So that's where the action is. We saw 11 fixtures last week and it was mostly driven by the robust US exports and Far East demand. We have seen the Houston Chiba, again the benchmark crude BLPG via Panama. It climbed around $136.5 per metric ton on the last day of the week. So TC ended the week around 63,752 per day. And you know what? That's strong. So what's more, we might see early September 25 liftings are kind of already tight. So we have got a situation where the market might stay firm heading into Q3, provided that the Northeast Asia demand should hold firm.
Alright, Sandesh, that's a wrap for today's voyage through the world of tankers and trade. And as usual, thank you so much for steering us through it with such clarity. And to all our listeners, we hope you have found insight and edge in today's episode. Until next time, navigate safely and stay informed.